All right, let's get right into it. If you're building a valuation model for a real estate investment trust, you know you can't just blindly plug numbers into a spreadsheet. You absolutely have to understand the structural foundation of the business first. So today, we're doing a rigorous pre-valuation fundamental breakdown of Independence Realty Trust, or IRT. We're grounding every single part of this analysis strictly in their 2025 and 2026 filings. We're going to look right under the hood at their operations to see exactly what is driving their cash flows, which is exactly what you need for your models.
Before we even think about setting up a DCF, we need to establish the sheer scale of this operation. IRT is a seriously heavy hitter in the mid-cap residential space. By late 2025, their market cap was hovering right around $4.2 billion. They own and operate roughly 34,500 apartment units, and the specific way they manage that massive portfolio is exactly what we need to unpack to really nail down their intrinsic value.
So here's our roadmap for this explainer. First, the IRT business model. Second, markets and resident demographics. Third, driving value and efficiency. Fourth, financial health and yield. And finally, market risks and positioning.
Let's kick things off with Section 1, the IRT business model. The real core of IRT's competitive moat is their vertically integrated structure. They don't just sit back and own the buildings. They actually manage and renovate them entirely in-house. They have a very specific target, undermanaged Class B and A- multifamily assets. And what's crucial for your assumptions here is their active portfolio optimization, or what they like to call asset recycling. Back in 2025, they sold off these mature, lower-growth assets in the Midwest and immediately deployed that capital straight into higher-yield markets down in the Southeast. Now, this breakdown is absolute gold for your revenue forecasting. Core rental income is obviously the main engine, driving 93.8% of total 2025 revenue, with average monthly rents hitting $1,665. But they aren't just collecting basic rent. They are aggressively monetizing these properties through a tiered pricing model and ancillary services. We're talking bundled tech packages, premium parking, pet fees, all of which generated an extra $42 million. That's high-margin income that flows virtually straight down to operating profit.
Moving on to Section 2, market and resident demographics. Management has been incredibly deliberate about clustering this portfolio. They are heavily concentrated in the Southeast, Smile states, and some very select Midwest markets. Why there? Well, because they're targeting non-gateway metros, where job growth is forecasted to be 3.5 times the national average. It's a simple equation, really. When jobs grow, housing demand grows. It's a fundamental demographic play that needs to be baked into your terminal growth rate.
So the real takeaway here is their geographic revenue dependency. When we look at the segment data from early 2026, Atlanta and Dallas are the undisputed heavy hitters. Together, they drive a massive 28% of the total net operating income. Columbus, Ohio is sitting closely behind at 7.5%. This kind of regional density doesn't just reliably capture demand, it actually reduces their per-unit operating costs because the local property management teams have such incredible scale.
To really get a feel for the stability of IRT's free cash flows, we have to look at who's actually cutting the rent checks. The resident profile is surprisingly balanced. 48% single, 52% married, with an average age of 37. This isn't unpredictable student housing, and it definitely isn't flighty ultra-luxury. It's a highly mature, working demographic spread across really resilient industries like medical services and tech.
And honestly, this next demographic data point is staggering. Their average rent-to-income ratio is just 22%. IRT is clearly catering to the renter by necessity. According to their filings, home ownership currently costs 89% more than renting in these specific markets. By keeping their rents relatively affordable, averaging about 34% less than brand new construction, they capture a huge, extremely sticky segment of the population that's essentially locked out of the home buying market.
Let's shift gears to Section 3, driving value and efficiency. The physical reality driving their financial growth is this highly targeted interior renovation program. By buying up aging Class B communities and completely overhauling their aesthetics and amenities, they can successfully command higher pricing. But the brilliant part? They're doing this without taking on the massive capital expenditure risks associated with ground-up development.
The math behind this value-add strategy is perfectly laid out for your valuation inputs. Step 1. They deploy CapEx of between $18,000 and $22,000 per unit. Step 2. That specific upgrade lets them push a rent premium of $200 to $300 per month. Step 3, that directly translates to an estimated return on investment of 16 to 20%. They've been running this exact, repeatable playbook since 2018, and it consistently forces serious net operating income growth.
But it's not purely about jacking up rents, right? It's also about optimizing operating expenses. The 2025 filings show a massive rollout of proprietary, AI-driven lead management and self-guided tours. That tech investment allowed them to slash their leasing office overhead by 12% in a single year. That's a structural change that directly protects and expands their operating margins going forward. Section 4. Financial health and yield. Let's look at the balance sheet. So, a major strategic pivot that you'll see highlighted across the 2024 and 2025 filings was a fiercely disciplined deleveraging phase. Management saw the writing on the wall regarding a higher-for-longer interest rate environment, so they actively dragged their net debt to adjusted EBITDA down from nearly 7.5 times to a significantly healthier 6.1 times. This materially lowers their cost of debt and gives them a kind of resilience that highly leveraged private equity peers simply don't have.
You can really see that balance sheet stability when you track their leverage over time. Right after their massive 2021 merger with Steadfast Apartment REIT, which literally doubled their scale, debt was running hot at 1.42. But by early 2026, thanks to strict capital management and opportunistic equity issuances, they essentially cut that ratio in half to 0.73. This conservative capital structure is exactly why they maintain a rock-solid BBB investment-grade credit rating from both Fitch and S&P. Now, for anyone running a dividend discount model, these stabilized, deleveraged financials easily support a steady payout. IRT is paying an annual dividend of 68 cents per share. Based on their early 2026 trading range, that spits out a 4.14% yield. It's a very reliable income stream, backed by those incredibly durable renter demographics we discussed earlier.
Finally, Section 5, market risks and positioning. We have to look at the downsides. As analysts, we have to weigh their undeniable operational scale against some very pressing macro risks. Sure, their Sunbelt exposure and in-house management grant them fantastic pricing power, but the filings explicitly outline growing regulatory exposure, evolving municipal tenant protection initiatives, and the rising localized threats of rent control proposals could absolutely put a ceiling on their long-term ability to push those lucrative rent premiums we modeled out earlier. The other glaring headwind is regional oversupply. Management's own MD&A notes that a massive wave of new apartment deliveries in key growth hubs, they specifically call out Austin and Nashville, is actively capping rent escalation and pressuring vacancy rates. While IRT's total portfolio occupancy was still a very healthy 94.7% in early 2026, these localized supply gluts are a highly tangible threat to same-store growth.
So, as we wrap up this operational deep dive, the ultimate question you have to answer for your final valuation model is this. Does their strict capital discipline, low leverage, and that incredible 20% renovation yield provide enough margin of safety to outshine the very real regional supply gluts and regulatory threats? You've got the hard fundamental data pulled straight from the source. Now it's time to build your assumptions. Thanks for joining me on this explainer, and happy modeling.